What is up, everyone? Welcome back to Finance Sphere. Look, the crypto market right now, it's remaining frustratingly, mind-numbingly stagnant. We are seeing a massive, aggressive capital rotation straight into traditional equities, specifically AI and semiconductors, leaving the digital asset space largely sidelined and left out in the cold. As a result, public interest has completely cooled down. It's practically frozen. Currently, exchange reserves are consistently declining, but stablecoin liquidity, the market's actual dry powder, is also hitting rock bottom. This strongly suggests one brutal reality. There is little to no new capital entering this market right now. Now, Bitcoin is frequently compared with gold as a primary store of value, but right now, BTC is trading at one of its most severely oversold levels relative to gold in recent history. It has been an absolute meat grinder of a period, forcing even the most diamond handed, long term holders to finally capitulate and cut their losses. Just take a look at this long cycle chart showing the percentage of Bitcoin supply currently in profit. This chart clearly shows that Bitcoin is experiencing one of the most severe, painful macro drawdowns in its entire history. In fact, Bitcoin has spent more time trading near its estimated production cost than at any point since 2015. So the big question on the table is, has Bitcoin actually reached its cyclical bottom? Here's the absolute bottom line. Current indicators suggest that rather than a final, definitive capitulation signal confirming we have completely hit the absolute floor, we have come incredibly close to the market bottom, but there is still room for one final, devastating move lower to shake out the weak hands. First, the MVRV ratio is currently sitting at 1.10. This metric compares Bitcoin's market price with its realized price, which represents the average cost basis of all investors in the space. Currently, that realized price, the average entry point for Bitcoin holders, is sitting around $53.1 thousand. An MVRV of 1.10 means Bitcoin is still trading slightly above its realized price. Historically, major cycle bottoms have formed when MVRV approached or briefly fell below 1, meaning Bitcoin traded below its realized price. This suggests that additional downside remains entirely on the table. Second, the long-term holder SOPR is currently at zero point 0.5. This metric tracks whether long-term holders with a holding period of 155 days or more are selling at a profit or a loss. This indicator has dropped off a cliff, meaning even long-term holders are throwing in the towel and realizing heavy losses. However, it hasn't reached the zero point 0.3 level yet, levels historically associated with extreme capitulation. So no, we are not in a full-blown final capitulation stage just yet. Third, the NUPL, net unrealized profit slash loss, recorded zero point 0.1. This suggests that the overall market is far from overheated and has cooled down substantially. However, historical bottoms were formed during periods of extreme, absolute panic selling. When this figure approached zero or moved deeply into negative territory. Therefore, the possibility of one final drop remains highly likely. Fourth, let's look at the Puell multiple, which measures miner profitability. This compares the daily value of miner rewards with its moving average. Right now, it has entered the green zone, which represents an incredibly attractive accumulation area. However, compared to the historical bottom level of zero point 0.3, there is still some room remaining. Fifth, the percentage of Bitcoin supply and profit has officially broken below the 50% level. In other words, more than half of all Bitcoin holders are currently underwater, sitting on painful, unrealized losses. Historically, when this ratio dropped below 50%, Bitcoin often entered a long, grueling consolidation phase before eventually recovering. Without a powerful macro narrative, a trend reversal will not be easy. So the probability of retesting the lows remains dangerously high. Therefore, it appears still way too early to confidently say that Bitcoin has reached its cycle bottom or that a new bull market has officially started. Of course, if macro conditions improve and global liquidity rushes back into the market, Bitcoin could immediately reverse to the upside in a massive short squeeze. But as of right now, we have not seen any meaningful signs of renewed liquidity. So this remains a period where careful, strict risk management is absolutely essential. Now let's turn straight to the derivatives market and examine why price action has become so wildly volatile. Right now, the crypto market is stuck in a fragile condition where spot trading volume remains incredibly weak, and leveraged trading activity in derivatives is driving all short term price action. While spot liquidity on exchanges is sitting near multi year lows, Bitcoin's short term movements are being fueled almost entirely by the futures market. According to a recent report by blockchain analysis agency CryptoQuant, monthly spot trading volume on centralized exchanges, which peaked at approximately $2 trillion during October 2025 at the height of the previous bull market, has recently cratered to around $700 billion. That represents a massive decline of approximately 67% from the peak and marks the lowest level in 2.5 years, clearly showing the complete exhaustion of market liquidity. In a recent report by digital asset brokerage platform FalconX, total spot trading volume across major exchanges recorded $1.6 trillion, representing a decline of 25% from the previous quarter and a whopping 42% year over year. Futures trading volume also took a hit, falling 12% quarter over quarter and 31% year over year. In particular, futures open interest more than halved from its peak of $122.2 billion to around $53.2 billion, strongly suggesting that leverage demand has weakened considerably. According to CoinGecko data, quarterly spot trading volume across the world's top 10 centralized exchanges also declined sharply from $4.5 trillion in the previous active quarter to approximately $2.7 trillion. With order books remaining incredibly thin, leverage remains elevated, creating extreme volatility. There is limited organic demand, while speculative positioning remains aggressive, creating a highly fragile market structure where sharp downside moves can easily trigger further liquidations. Additionally, short term holder SOPR needs to fall below 0.95 to signal a complete, total panic capitulation. However, a massive short squeeze or a brutal liquidation cascade where whales or market makers completely sweep liquidity below recent lows has not yet appeared. In other words, the market has not fully reached that final, agonizing bottoming stage. For a sustainable, healthy upward trend to begin, we cannot rely solely on derivatives indicators. Instead, spot buying volume across major exchanges needs to surge, and CVD, cumulative volume delta, must turn into sustained net buying pressure. Now, let's take a look at the charts. Bitcoin has undergone a correction of approximately 280 days from its previous peak, falling around 53%. Altcoins have experienced an even deeper, soul crushing decline, dropping more than 70% across the board. On the monthly chart, June closed with a full bodied bearish candle. Historically, when a monthly candle closes with a large, ugly, bearish body like this, the following candle has often gone on to print a brand new low. Even if a relief rally occurs in the following month, Bitcoin has frequently returned to retest those lows. Therefore, based on the monthly structure, another 2 to 3 months of choppy downside remains entirely possible. On the monthly chart using logarithmic regression bands, Bitcoin is currently positioned in an incredibly attractive valuation zone. However, although it appears fundamentally undervalued, it has broken below a major long term trend line. If Bitcoin fails to reclaim this trend line quickly, it could become a powerful resistance level and leave room for further downside. This is a crucial level that requires careful monitoring. Looking at the weekly chart, Bitcoin broke below the 200-week moving average, one of the most important long-term technical indicators in existence. Historically, when Bitcoin lost this level during previous cycles, it often went on to retest the deep lows. On the other hand, when Bitcoin successfully held the 200-week moving average and recovered, it marked the definitive end of the bear market and the beginning of a massive new upward trend. Currently, Bitcoin has broken below the 200-week moving average and is consolidating around this level again. Whether this bear market ends right here or whether Bitcoin experiences another downside flush will largely depend on whether meaningful liquidity finally returns to the market. If Bitcoin rebounds after finding solid support at the 200-week moving average, a strong bullish divergence could develop on the weekly chart. Weekly bullish divergences are relatively rare, and identifying one early could provide a highly favorable, life-changing entry opportunity. Remember, a bullish divergence occurs when price makes a lower low, while momentum indicators form a higher low, suggesting that selling pressure is finally beginning to run out of steam. Looking at the volume profile, $48,000 is a very important level from a long-term perspective. This was the exact price zone where Bitcoin rebounded after the approval of the Bitcoin ETF, and it later acted as rock-solid support after the post-ETF correction before the next major bull market move began. This suggests that significant whale accumulation took place around this level. Because substantial volume has traded here, this zone could provide strong long-term support. At this point, we do not know whether Bitcoin will revisit this level by making another lower low. However, if Bitcoin does decline toward this zone, instead of viewing it as a reason to panic, investors should consider it as a potentially attractive long-term opportunity and evaluate a gradual scaling in approach. Moving to shorter time frames, I am closely monitoring the 20-day EMA for Bitcoin and the 28-day EMA for Ethereum on the daily chart. Currently, both Bitcoin and Ethereum are testing whether they can hold support while consolidating right above these moving averages. Moving down to the 4-hour chart, there is an encouraging signal. The chart is showing a double bullish divergence where the price printed two consecutive higher lows on the indicator, suggesting that downside momentum is weakening. Bullish divergences are relatively common, but a double bullish divergence is much rarer, which makes this signal far more significant. Therefore, even if Bitcoin prints another low, the current correction could end much sooner than many expect, with the trend potentially reversing violently to the upside. The key thing I'll be watching is whether liquidity returns strongly enough to support a broader trend reversal. Eventually, sellers run out of inventory, and once selling pressure is exhausted, there is simply less supply available to push the market lower. At this stage, bearish momentum appears to be gradually weakening. While much of the market has completely lost interest and moved on, whales have quietly continued accumulating Bitcoin. Over the past month alone, whales have accumulated approximately 270,000 Bitcoin. Historically, during periods such as March 2020 and November 2022, when Bitcoin experienced major price declines and severe market stress, periods of massive whale accumulation were later followed by explosive rallies. The RWA sector is also continuing to expand rapidly. In particular, capital inflows are accelerating across areas such as reinsurance, real estate, equity, ETFs, multi-asset RWAs, and mixed public markets. This highlights how traditional finance is gradually moving onto blockchain infrastructure. In other words, while the public leaves the market believing that crypto is finished, whales and institutional investors are quietly positioning themselves for the next bull market and preparing for the tokenization of real-world assets. Therefore, if the market experiences another sell-off, instead of panic selling, investors should consider whether it represents an opportunity to position themselves for the next major cycle. Remember, the greatest wealth building opportunities have always come when the crowd looked the other way. If today's video was helpful, please subscribe and like. Thank you.